tutorial, I'd like to cover the Quantopian pipeline. The pipeline is designed to solve trading algorithms with the following structure. The first characteristics is that for each asset in a known set, you compute the n-scalar values for the asset based on a trailing window of data. An example, these could be moving average, could be standard deviation, or the likes. The second characteristics of these kind of trading algorithms that pipeline is trying to solve is that you are trying to select a smaller tradable set of assets based on the values computed in part 1. In part 1, let's just say you calculate the standard deviations and you really want to focus on low volatility or low standard deviation stocks. You can, using pipeline, to select those stocks that is below, let's just say 5% or 10% standard deviation, whatever that you determine that is suitable for your algo. The third characteristics is that after you have done the step 1 and step 2 really is that you want to calculate the desired portfolio weights on the set of assets selected in 2. And the fourth and last step really is that you place orders to move the algorithm's current portfolio locations to the desired weights computed in part 3. Now, there are a few challenges in doing this without pipeline and doing it robustly. And then first and foremost is that you are working with a couple of thousands, if not tens of thousands of assets or stocks in our case. So you need to be able to efficiently query large sets of data. Now, normally market data is what you will pull up, such as open, high, low, close, and the volume as well. Nowadays, you need to pull up fundamental data. It could be satellite data, it could be other alternative data sets that you want to actually pull up for your algorithm. And then after that, after you query, after you actually downloaded or extracted the data from the database, you need to perform computations on these large sets of data, or large sets of assets, I should say. After you've extracted these data from the database, the next thing that you really want to do is to perform computations on these large sets of assets. And ideally and hopefully, the backend you have an algorithm or the so-called corporate announcements such as stock splits, reverse splits, dividends are all accounted for automatically, and also asset delisting as well, or mergers and acquisitions. These are all accounted for in the backend for you. Now, pipeline really is designed to solve these problems by providing a uniform API for expressing computations on a diverse collections of assets. In the design workflow of algorithmic trading, the ideal process is that you start with the research phase. In Quantopian, you will be using the research notebook or the Jupyter notebook as it is known. And in the implementation phase, you will move to the IDE. One of the features of the pipeline API of Quantopian is that you can actually do both of these either in the research or IDE, and they're exactly the same. You don't actually have to change after moving from one environment to the other. Now, I guess there is actually some differences. However, that's really how it is run at the back end. It's not something that you will have any visibility or it will affect you in any way at all. In pipeline, there are 3 types of computations that can be expressed: factors, filters, and classifiers. I'll go through them briefly now. In tutorial 3, 4, and 5, I will go into them in a little bit more details. So, in a simplistic way to distinguish between the 3 of these is that factors value is in the form of numerical value or real numbers, whereas filters is in the form of Boolean, so it's either a yes or a no, and classifiers will be in the form of categorical output. So if I use student grades, for example, it will be A, B, C, D, F. So those are the categorical output that we are referring to. Now, those categorical output could be in the form of string or integer. So let's look at the definitions that's provided for here and the Quantopian tutorial website. So let's start with factors. The definitions here, a factor is a function from an asset and a moment in time to a numerical value. So this is what I was referring to when I was talking about numerical value. A simple example of a factor is the most recent price. And price, as you know, can come in, well, any form, in the form of decimals, really. Given a security in a specific point in time, the most recent price is really a number. Another example is the 10-day average trading volume of a security. Factors are most commonly used to assign values to securities that can be used in a number of ways. And the factors can be used in each of the following procedures. You can use it to compute target weights, generate alpha signal, constructing other more complex factors, or constructing filters. Now, these are a little bit abstract right now. As we go into the other tutorials, you will be able to actually get a better grasp of it. Factor, I guess, probably one of the easiest way, if you're coming from a finance background, is the Farman-French beta. So that's the sensitivity of the assets to the so-called Farman-French factor. So the number could be any decimal place at all. So basically it's a real number. So it could be 1.2, could be 0.56, so anything of the likes. So going to filter, a filter is a function from an asset and then a moment in time to a Boolean. Notice that the definitions is very specific. It refers to assets, it refers to a specific moment in time, and in this case, for filters, it's a Boolean. It's either a yes or no. Okay, so an example of a filter is a function indicating whether the stock or the security price is below $10. Given a security and a point in time, this evaluates to either true or false. Filters are most commonly used for describing a set of assets to include or exclude for some particular purpose. One way to use it is whether the average trading volume is above or below a certain so-called benchmark or level that you like it to be. If it's below, you deem that is illiquid, so you don't want to trade that stocks. So in those situations, what you will do is that you will filter out by using these filters. A classifier really is a function from an asset and a moment in time to a categorical output. More specifically, a classifier produces a string or an integer that doesn't represent a numerical value. Example, an integer label such as sector code. Classifiers are most commonly used for grouping assets for complex transformations on factors outputs. An example of a classifier is the exchange on which an asset is currently being traded. The other common usage of a classifier is to rank them, rank stocks based on, let's just say, use the example of price to earnings ratio. So you can rank them into 10 categories based on quantiles, deciles, and basically classify them that way. You can also use pipeline to perform computations on different data sets. One of them being the market data, which is your typical open, high, low, close, and volume. Fundamental data or partner data that Quantopian provides, such as sentiment, such as earnings calendar, and many, many others. You can look that up under the Quantopian data. We will go through these in later lessons. A typical pipeline usually involves multiple computations and data sets. And in the following tutorials, we will build up a pipeline that selects liquid assets with large changes between the 10-day and 30-day average price.